Are more and more electric cars out on the roads, and one reason may be because there are thousands of dollars in incentives to help reduce the cost of them.
EV leases are getting remarkably cheap, and it's not just due to sheer luck. With such jaw-dropping deals, one might wonder, why would automakers practically give away these cars? Well, there's more than meets the eye, and it could spell trouble down the line for both the automotive industry and consumers. Automakers are currently offering substantial discounts on EV leases, up to 30% off the sticker price in some cases, a much larger discount compared to what you typically see on conventional cars. Many leases are taking advantage of a loophole in the Inflation Reduction Act, which allows them to cash in on a $7,500 tax credit that wouldn't be available if they bought the same EV outright. With lower payments, no long-term commitment, and no need to worry about resale value, it all sounds like a deal that's too good to pass up. However, there's more to this story, and it raises questions about the future of the electric vehicle market. So, how exactly did we get here, and what does this mean for the future of electric vehicles? Well, keep watching to find out. Why are automakers so eager to lower the prices of EV leases? At the core of this perfect storm lies a combination of rising inventories, slowing demand, and fierce competition within the EV space. By mid-2024, automakers were slashing prices on electric vehicles across the board. Discounts of 15 to 30% off the original sticker price were becoming the norm, making leasing a far more attractive option. These discounts are substantial when compared to the 5 to 6% incentives typically offered on gasoline-powered cars. But why are such deep cuts necessary? The EV market, once driven by early adopters, is experiencing a slowdown as it tries to expand beyond that niche. Automakers are grappling with how to sustain demand, especially with rising interest rates and growing economic uncertainty, making consumers more hesitant to make large purchases. Leasing, with its lower monthly payments and shorter commitments, is a much easier sell than buying a new EV outright. One major factor driving the surge in EV leases is the ability to tap into federal incentives that wouldn't otherwise be available. The Inflation Reduction Act offers a $7,500 tax credit for electric vehicles, but there's one key caveat. The vehicle must be made in the US and meet specific battery material sourcing requirements. However, this restriction doesn't apply to leased vehicles. This means that by opting for a lease, consumers can still benefit from the $7,500 tax credit, even if the EV they are driving isn't built in the United States. Essentially, leasing has become a clever workaround, allowing manufacturers to offer cheaper deals while still reaping the benefits of the federal incentive. This works out well for everyone involved for now. Customers get cheaper EVs and automakers move more units. However, this loophole could set up a significant challenge down the road, particularly as the market becomes saturated with returning lease vehicles. Leasing has become the go-to strategy for automakers looking to accelerate EV adoption. Though leases account for just about 23% of all new car sales, they now represent 35% of all EV transactions and a staggering 70% of EVs sold through dealerships. The rise in leasing is a clear sign of where the market is headed, at least for now. However, what's good for boosting short-term sales may turn into a long-term problem. The current trend of low-cost leases is setting up a ticking time bomb for the used EV market. With more and more electric cars leased, the market will soon be flooded with used EVs returning from their lease terms. This influx of returning vehicles will further drive down prices, potentially leading to collapse in residual values, the estimated worth of the vehicle at the end of the lease term. This issue is already starting to unfold. By May 2024, the price of used EVs had dropped by 16% year over year, compared to a 12% decline for internal combustion engine vehicles. EVs, particularly those leased, are expected to retain only about 55% of their original value at the end of their lease terms. However, even that figure might be overly optimistic. As more EVs flood the market, it'll become increasingly difficult to maintain decent resale values. For now, cheap EV leases are a win for consumers, but they pose a significant long-term risk for automakers. Companies like Ford and GM are already facing massive financial losses in their EV divisions. Ford, for example, is expected to lose $5.5 billion on EVs in 2024 alone, while GM is projected to lose $4.5 billion. These losses are being offset by the profits from their internal combustion engine vehicle sales, but relying on gas-powered cars to prop up EV ambitions is not a sustainable business model. The real issue that has been overlooked is depreciation and falling resale values as more EVs are pushed through leasing. Eventually, the point-of-sale prices of these leased vehicles will come back to haunt automakers when they flood the used car market. Companies will have to find a way to offload these cars without damaging their brand image or financial stability. Long-term profitability hinges on a healthy resale market, and if residual values collapse, it could send both consumers and investors running. Leasing may not always be the best financial decision for consumers either. While monthly payments are lower, leases are structured in such a way that you're essentially paying for the steepest depreciation period of the car's life, the first few years. By the time the lease is up, you've paid for most of the vehicle's depreciation, only to return it and start the process over again with a new lease. Over time, 2 back-to-back 3-year leases could end up costing more than simply buying the car and keeping it for 10 years. This wave of cheap EV leases could reshape the entire used car market. As more leased vehicles return, they will flood the market, pushing prices even lower. Already, the resale value of used EVs is lower than that of gas-powered cars, and this gap is only expected to widen. In the worst-case scenario, automakers could find themselves trapped in a vicious cycle, artificially inflating short-term sales through leases, only to see those cars return and flood the market, damaging profitability in the long run. While consumers may enjoy short-term benefits from lower prices, especially in the used car market, automakers could be left in the financial quicksand, struggling to escape the consequences of their leasing strategies. Not too long ago, the future of EVs looked incredibly bright, with seemingly endless demand and optimism propelling the market forward. However, we've now entered what some analysts are calling an EV winter. The early adopters have already gotten their cars, and automakers are struggling to capture the interest of the mainstream consumer. Leasing has been one way to bridge the gap, but at its best, it's a temporary solution. As the EV market matures, automakers will need to find a way to make electric vehicles appealing without relying on heavy discounts and lease incentives. Otherwise, they risk undermining the very market they're trying to build. So, what's next for EV leasing? For now, consumers are in a good position, with some of the best EV lease deals ever seen. The big question is, how long will it last, as more vehicles come off their leases and flood the market? With profitability challenges and a softening market, the outlook for EV leasing in the future could become far less generous.